All right. Good evening, everybody. My name is Carla Carter. Miss Carla Boston Carter. I am the proud owner of TBA Tax Group or the Boston Agency LLC. I apologize. We do have people still coming in. So tonight's workshop is called Understanding My Taxes and the Big Beautiful Bill. Some of you guys were questioning what the BBB was, but it's one big beautiful bill. And so there are a lot of significant changes that happened when the One Big Beautiful Bill Act was signed, and it's going to take effect on our taxes for this year coming up that we're going to file. And so I wanted to make sure that everybody was clear on what was coming down the pipe. Also, get you guys muted out. Also, if there's anything that you guys can actually do to kind of help offset anything, because if there's anything that needs to be done, it needs to be done by December 31st of this year. So it's not too late to do certain things to kind of help if we need help. But right now, I just want to give you as much information as I can, and you can determine yourself whether or not it's something that you need to do on your own. I do anticipate a pretty nice sized crowd. So what I'll do, as we go through the information, I'll take a couple of pauses for us to be able to ask questions and get some questions answered, to not go so far into the presentation. It's not a long presentation anyway, but the main thing that we're going to focus on is actually doing live examples, because for me, I'm extremely hands-on learning. Like I'm not gonna say I can't. I'd much rather see it in order to understand what's going on than you just telling me. And so for that reason, I'm going to have a lot of live examples. Okay, so let's just jump into it real quick. I'm going to try not to get distracted as I'm letting people in while I'm talking. Okay, so understanding my taxes and the big beautiful bill, some of the things that we're going to go over. Oh, well, before I start, let me say this. If you guys can make sure your cameras stay off and make sure you stay muted until it's time for questions and answers, to make sure we don't get distracted or distract me because I have ADD, grown up kind, or distract anybody else that's trying to listen. Try to stay muted out and keep your cameras off. But, okay, so what we're going to go through is how to understand and read a tax return, because that's very important. How to properly fill out your W-4 form or W-9 form. And then also we're going to discuss some of the tax law changes that have happened. We're going to also discuss the One Big Beautiful Bill. And then I want to show you guys how to make proper adjustments based on the information that you receive, and how to save on your taxes and maximize, the income that you make. And so let's jump right into it. All right, this is going to distract me. If I can get everybody coming in and get settled in, I'm having to continue to mesh. Okay. That being said, okay. So let's break down what is a tax return first. Of course, you guys know what a tax return is. Y'all file taxes, but I really want you guys to understand the way it works, right? And so I'm going to give you an example. I've given this example many times. So, for example, let's just say you want to sell T-shirts in a mall, right? Well, we'll just do this. Say you go into a store in the mall and you want to buy 10 T-shirts, okay? And you get to the register and you have these 10 T-shirts here, and the cashier says, well, my register is broken. I can't really give you an accurate amount of how much it's going to cost for the T-shirt. And so we can take a guesstimate, and you just give me $10 per shirt, okay? And so I give the cashier $100, and the cashier says, you know what? Whenever my computer gets back up or my register gets back up, what I will do, you bring your receipt back, and if the T-shirts are less than $10 each, I'll give you a refund. If the T-shirts are more than $10 each, then you'll owe me a little bit more money. And if the T-shirts happen to be the same amount, we break even, right? And so that's the way the tax system works as well. And so when we're working and we're making income, right, and especially W-2 employees, they're taking out taxes based on the way you fill out your W-4 form, because on your W-4 form, you're pretty much guesstimating the income that you're going to make, the filing status that you're going to have, the credits that you may have, things like that. And they say, okay, well, based on your W-4 form, we're going to take out a certain amount of taxes each month for every time you get paid. And at the end of the year, when you do a return, a tax return, and you put the actual income in the system, and they may say, okay, hey, you paid us too much money based on these credits with your dependents or whatever, so we're going to give you a refund because we took out more taxes than you actually owe us, or you didn't take out enough taxes or give us enough taxes throughout the year, so you owe us more money, or we took out exactly the right amount and you break even. Does that make sense to everybody? So that's pretty much the gist of a tax return. You're kind of guessing how much taxes you're going to make. I mean, you have to owe at the end of the year for the income that you made for the year, right? And so that's what a tax return is. I want to break down the 1040 so you can kind of understand what this looks like. Let me bring this over to this screen here. All right, so this is an actual dummy return. This is for Jane Doe. I'm going to pull up her 1040 form, okay? So on a 1040, no matter what year, this is 2024, they have not given us the, my screen, let me see. Or is it too small? Do I need to make this bigger? Can you guys see this okay?
For us old folks,
Yeah,
can you make it a little bigger?
I can. Let me do this real quick. All right. Let me make it a little bit bigger. If I can. Is it going to let me make it bigger? It won't let me make it bigger. It won't let me make it bigger. Sorry.
Hey, you can actually
All right.
you should be able to take your finger and spread it out just like you would a picture, and you'll be able to see it better.
Okay, thank you. That sounds like Nathaniel. Thank you. All right. So
Yeah,
on a
that
tax
works.
return, the way perfect. Awesome. All right. So on a tax return, this real quick, simple explanation, because we're going to need this to kind of understand the W-4 form. On a tax return, the first thing you'll see on the 1040 tax return is the filing status first. The filing status determines what your standard deduction is, which we'll talk about that in a minute. So you see the filing status of the individual. You'll see the person's name and social and address, all that information. And then you'll see the standard deduction. You'll see if they have dependents. You'll see that on here. And so the standard deduction information, if the person is a dependent on someone else's taxes, blah, blah, blah. And then it comes down to this. This is the main part. All right. And so on the 1040, it's broken down by income, deductions, taxes, credits, and payments. That's how a 1040 is broken down. A lot of you need to learn how to read your tax return, especially if I'm not doing your taxes, just to make sure whoever is doing the taxes, you'll know what's on your tax return. A lot of shady people out there. So let me just do this real quick. I'm going to create just a dummy W-2. Let's say this person made $50,000 for the year and paid in $5,000, 10%. On this W-4, when you get to the income, it calculates all the income. Line 1 is going to be W-2 income. Then you have household employees. You have all those different incomes from a W-2. And then you have dividends. You have interest income. You have IRA distributions, or sometimes you would call that pensions, which would be like retirement income or IRA or pensions and annuities. That goes on line 4 and 5. And then Social Security benefits, if any of that has to be taxable, that goes on line 6. Any capital gains or capital losses will go on line 7. And any other additional income goes on line 8. And then that gives a total of the total income. If there's any adjustment, remember, income, deductions, taxes, credits, payments. So we have the income. Any adjustments made happens on line 10. Normally, that's only if they're self-employed or some very other minor issues. And then the adjusted gross income. If there was any other income here, the adjusted gross income would go on line 11. But since this person only has a W-2, it's going to be the same as the total income. The standard deduction or itemized deduction, this is where the filing status makes the difference. If the filing status is single, the standard deduction is $14,600. What is a standard deduction? A standard, we all know what standard means. It's the same across the board. It's a standard for everybody across the board. And that means, based on your filing status, everyone with that particular filing status has a certain deduction that they are allowed to take away from their income that they don't have to pay taxes on. And so for someone filing single, then $14,600 of that $50,000 that they made, it's deducted, and the total taxable income that you're going to have to pay taxes on will be $35,400. So the standard deduction kind of offset the taxes that you have to pay. Okay, and so the taxable income is $35,400. Based on that taxable income, the taxes that are owed on that $35,000 is $4,019. Okay. If there were any credits, like earned income credits, any type of credit, that would have been in between here. It's not line 17, line 19, depending on what type of credit. Since this person is single, no dependents, no credits, there's no credits added to any of the taxes. And so then, because the person did pay $5,000 in income tax, then the taxes owed $4,019, and you apply the payment that the person made throughout the year, which is $5,000 that they paid towards their income, and then that gives them a refund of $981. And so you just subtract the taxes owed from the $5,000 that was paid in, and that's how the refund is calculated. Pretty simple, pretty basic. Is everybody clear on that part? Don't need to redo anything. Good, we good? Okay.
Good.
Latara, what you got?
Good.
Latara, your hand up. What you got, Latara?
I'm sorry. Where was the 5,000 come from again?
On
Or
the
we ain't
W2,
get to that part
remember
yet.
on the W2, so she made $50,000 and she paid in $5,000
Okay.
worth of taxes for the year. Mm-hmm.
Okay.
I'm glad you asked that question. Somebody else may have had the same question. And so basically, your income, deductions, taxes, credits, and all those things like that. Let's just say that this person filed head of household. Let's change the head of household, right? Head of household. Let's go back to this. See, the refund jumped up from $981 to $1,956. No dependents. But because she's filing head of household, there's a higher standard deduction. Okay, so there's a higher standard deduction. And the standard deduction changed from the $14,000 blah 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 to $21,000. $21,900. And so that deducted more from the $50,000. So she has less taxable income. So that means she has to pay less taxes because of her filing status. That's going to be key with some of the tax law changes. Okay, but she doesn't have a dependent. And so she has to file single because she has no dependent, no qualifying dependent or anything like that. I just want to show you that the filing statuses do make a difference. If she was filing with her spouse, married filing jointly, the standard deduction goes up to $29,200, and that also makes the taxable income a lot less. So the filing status plays a big part as far as the deductions go on the total income. Okay, and that comes off of the adjusted gross income. Everybody clear on standard deduction? Well, what's the difference between the standard deduction and the itemized deduction? Itemized deductions are what you would put on what we call a Schedule A, and it used to be before 2018 where you could actually itemize work-related expenses. A lot of people work from home now. A lot of work-related expenses could have been itemized, medical and dental expenses, local and state taxes that you pay in, property taxes, car tags, interest on your home, sometimes HELOC or home equity line of credit interest, charitable contributions, and things like that. Now, the only time itemized deduction makes a difference on the federal tax return is when the amount of the itemized deductions total more than the standard deduction. So if the standard deduction, we're going to go back to single. If the standard deduction for single is, say, $14,000, And we're going to go back to itemize. Let's say the property taxes in Texas, property taxes high, $10,000 for property taxes. Let's say the mortgage interest is $8,000. Charitable contributions, let's say it was $5,000. Things like that. And so once I hit refresh, it's going to update, and that actually made the refund go up to $1,989 versus the $900, and I'll show you why. Because now those itemized deductions replace the $14,000 standard deduction. So on line 12, see where it says standard deduction or itemized deduction? The itemized deductions makes a difference on the federal tax return if the certain itemization equals more than what the standard deduction is. Now, keep that in mind when we start talking about the tax law changes and what happened in 2018 that pissed so many people off. Try to make sure I watch my words, okay? But that's the standard deduction or itemized deduction, and that's the basics of a tax return. Now, let's just say, for example, and I'll get rid of this. Let's just say, for example, Jane Doe also had some type of side hustle or 1099, or she did something on the side, and say she made 1099 a self-employment income of about, say, $5,000. When I hit save, you still have the $50,000 worth of W-2 income, but then that additional income goes on line 8 of $5,000, which makes the total income now $55,000. And there's an adjustment for being self-employed of $354 that comes out of that. And then the standard deduction comes out, so forth and so on. But, sorry. Say, for instance, she had expenses of, say, $10,000 worth of expenses total. And so that shows a $5,000 loss. She made $5,000, but spent $10,000 with this 1099 or self-employment or side hustle or whatever. When I hit refresh, that takes away from the adjusted gross income. And so, of course, it makes the refund go up higher because the adjusted gross income drops. Because remember, it was $50,000 on the W-2, but because there was a $5,000 loss with the business or the side hustle, then that has to come out of the W-2 income. So the total income is $45,000, and so of course that makes the refund go up higher because the adjusted gross income is less. Keep all this in mind, okay? But when you do it this way, it helps on the taxes, but when it's time to borrow money from banks and things like that, it can cause an issue because they go off of your adjusted gross income for loan purposes. So let's keep all that in mind, okay? Now, any questions on how to read a tax return?
No, Paula, when you were talking about those standardized deductions and what made people mad, you just kind of say again, those deductions you can no longer charitable contributions. I mean, I make an effort to do those charitable contributions last year, and come to find out it didn't even matter. Mortgage interest. You're saying the new tax bill again, you can't write off these things?
You can write those things off, but if they don't, those things. Now, work-related expenses, you cannot. There's a cap on how much you can write off as far as property taxes. They put a cap on that also, which we'll talk about in a minute. But if your total contributions and property taxes and things like that do not exceed the standard deduction, it will not make a difference. But with you being in California, it still helps you though. And so you still do it because it helps you on your state taxes.
Gotcha.
Because we're going to talk about that as well. Because a lot of tax preparers, after the changes happened in 2018, were telling their clients that you don't have to write off anything. You don't have to write off your mortgage interest anymore. Probably it doesn't make a difference anymore. But that was only on the federal side. The only time it doesn't make a difference is if you're like in Florida or Texas or Tennessee, places where there are no state income taxes. But if you have state and local income taxes, those things absolutely make a difference for sure. And I'll show you that in an example once we go through some of the tax laws.
Hey,
Okay.
Carla.
Any other questions? Yes.
Yeah, I have a question. You said something, and I want to clarify something. You said that when you go to a bank to get a loan, it can hurt you as far as your income. Clarification on that. My being that I worked in banking, the only way it will hurt you if you're a self-employed employee where they would base it off of your tax return. But if you are a W-2 employee, they're looking at your gross salary. So I just want to clarify, is that that's the difference that you're meaning? It's based on more if you are a self-employed employee where it could change your adjusted gross income. But for a W-2, banks mostly just look at your gross salary is what they go off of, and your debt to income ratio on that side.
That's true. Depending on the loan, the type of loan that you're getting. If you're
Okay.
going for a house, they look at your tax returns. Because I've
Okay.
had to prepare
Yeah,
so
you're right.
many
You're right. You're right.
letters to explain to them. And so there's a way around that too, though, where you still can write stuff off, which we'll get to that in a minute. That's why it's better to depreciate versus just writing a lot of stuff off. It still
Gotcha.
have the same effect, but depreciation is added back to it. And so it really does depend on the type of loan and the relationship that you have with the bank. But for most banks and the type of loans that we have to get, they look at the tax return if it's something that the federal government has to regulate, like a
I
FHA loan,
gotcha.
things like that. Car loan, no, because
Yeah,
you
like
do that
just
in-house
regular
anyway.
personal loans. Okay. Yeah, that's why I wanted
Yeah.
clarification on that to see which type of loans, but I didn't even think about mortgages. You're exactly right.
Yeah. Okay.
Thank you.
You're welcome. Yes, Jeanette, you're absolutely right, because Jeanette actually works with a lot. She's in the real estate market, so yes, yep, we're all on the same page. Perfect. Awesome. Okay.
Carla,
And we'll talk. Yes, ma'am.
I just want to ask, and if I'm too far ahead, you can just let me know. If you don't have enough deductions, my tax person said you gotta, you can't write off these things, so you don't have enough to itemize.
That's not true. You absolutely would have enough to itemize if it's on the. It'll help you on the state. It don't help you on the federal, but it does help state. Itemize everything. that you
Gotcha,
can
but on
itemize.
federal, you have to have so much, right, to be able to do that the Schedule A that you spoke about.
Right.
Or
Still do the Schedule A because you can still do the Schedule A because it'll help you on your state taxes. It may not make a difference on your federal taxes. It may not make that change, but it does help you on your state taxes for sure. And I could do it when we get to the examples. I could do one for California and show you the difference because
Gotcha.
the standard deduction for California is a whole lot less than the federal standard deduction.
Yes, I've noticed
Mhm.
more with the state tax. Thank you.
Mm-hmm. You're welcome. All right. Any other questions before we continue? Okay. Good questions. Very good questions. All right. So we talked about standard deductions, things like that. Different filing statuses. Let me explain the filing statuses because that also changed as well. This may help a lot of you. So of course, filing status is single, head of household, married filing jointly, married filing separately, and widower. Now, for the married couples that I have, especially those of you who, work in different places, he may work here, you may work there, blah, blah, blah. The rule is, because some people will file married filing separately, and if you have dependents, that hurts the dependent part of it because you forfeit your earned income credit for that dependent if you file a married filing separately return. You don't get any earned income credit even though you're claiming you're dependent. And so sometimes that can actually hurt versus help. But you may not want to file with your spouse. They may owe taxes or owe something else and you don't want to file with them because the refund may be taken, blah, blah, blah. You still can file with your spouse, and there's something called injured spouse form that you can fill out or your preparer can fill out and let them know that you would be an injured spouse if they take the refund because the debt is not yours, and you still get to keep your refund, your portion of the refund regardless, and they'll take the rest to put towards that your spouse's debt. Also, you can file married filing. If you're married and you're not filing together, one of you can file single, the other can file head of household if children are involved, or you both can just file single. But if children are involved, one can file single, one can file head of household. if you did not live together for the last 6 months of the year, you were considered unmarried in the IRS's eyes as far as tax laws go. And so most of my clients, they just, they may file, when they file single, when they file as a spousal, because they did not live together for the last 6 months, and they use whatever address that they lived at for the last 6 months on their tax return. And then, of course, as a widower, if your spouse has passed away, you can file as a widower to get the widower filing status deduction up for 2 years after they pass away. And after that, you have to file single or head of household based on your dependent information. Now, I'm saying all this to get to the tax brackets, the credits, and then we'll look at the W-4 forms, because all this information makes a difference when you're filling out your W-4 forms for work. All right, so let's move in. All right, so the tax brackets for 2024 that we just had, and then the tax brackets for next year, 2025. Well, this year, 2025. And so the tax rates stayed the same. They did not change. The only thing that changed from 24 to 25 was the amount of income in each category. For example, in 2024, when we filed taxes, then you had to pay a 10% tax rate on any income that's over the standard deduction, on any taxable income. For example, if you file single and you made $50,000, and after the deduction is taken out of $50,000 and you have $30-something thousand left over, that $30-something thousand that's left over is put into these brackets. So the first $11,600 of that $30,000 is taxed at a 10% rate. Whatever amount is left over from that first $11,600 goes into the next bracket. And if it falls in this bracket, the rest of that that's left over is taxed at a 12% rate. And so it doesn't mean that if your income, say, is $30,000, that the whole entire $30,000 that falls into this bracket will be taxed at 12%. It doesn't work that way. It goes into different brackets. So if you've made, say, $50,000 as your taxable income, the first $11,000 is taxed at 10%. The other $40,000 falls into this bracket, and the $40,000 is taxed at 12%. And that's how the taxes are calculated based on the income tax bracket that your income falls in. Does that make sense to everybody? Or is it anybody that doesn't make sense?
Yeah, that makes a lot of sense. I did not know that, Carla. That is good to know.
Yep. And so knowing these tax brackets is a good idea to have that in mind based on if you have some type of side hustle, you'll know what tax bracket that you need to be in. And when you see that those expenses that come off, it changes your adjusted gross income, and so you're taxed at a lot lower rate, blah, blah, blah. So that's something to keep in mind. But the rates did not change. The amount didn't change much either. It only changed $325 in the first 10% bracket. Not much. And so there wasn't too many big changes in the income tax brackets based on the Big Beautiful Bill, but there are some things that changed kind of drastically. But I was over it. I hope I don't get emotional about it though. Let's see, what's the amount?
Carla, I'm sorry, is investment income tax the same?
I'm so sorry. Say it one more time.
Is investment income tax the same? If part of your income is
yes. So this is your adjusted gross income. So no matter what type of income it is,
okay,
once it's all bottled up in your adjusted gross income, all of that is included in that
okay.
component.
Okay.
Mhm. Okay. All right. Okay. So then I'll go through the standard deductions for the new tax year, so you guys know the standard deduction, and then also the head of household deductions as well. But yeah, so let's do this real quick. All right, so the tax credits. Let's go through the credits real quick, just for the sake of time, and then I'll answer individual questions in just a second. Let me let some more people in. All right, so tax credits. There's a such thing as a refundable tax credit and a non-refundable tax credit. Now, this is going to make all the difference in the world. and this is where I really need a lot of my clients to really understand how this works. All right, so the earned income credit, that's a refundable credit. The additional child tax credit is refundable, and a portion of the American Opportunity Credit, which is what we call the college credit, is also a fully refundable credit. Partial refundable credit. All right. The non-refundable tax credits are as follows: child tax credit, other dependent credit, so forth and so on. So these are non-refundable. What's the difference? Remember we talked about bringing your receipt to the T-shirt place, right? Now on a tax return, the refundable credits, no matter what your adjusted gross income is, no matter what taxes you owe, if you qualify for this credit, it goes towards your refund, period. A non-refundable credit is a credit that you get that only goes towards taxes that you owe. And once the taxes that you owe is covered, if there's anything left over in that credit, it doesn't go towards your refund, it just kind of phases out. For example, say the income is a certain amount, total taxable income is a certain amount, and the taxes owed is $1,000, and say the child tax credit is $2,000, because, or so whatever non-refundable credit, say $2,000. Once that $1,000 taxes that is owed is paid from that credit, if it's a non-refundable credit, the rest of the $1,000 that's left over just goes into nothing. It doesn't go towards your refund, but it's kind of, you don't get anything refunded from the credit. Okay, and I'll show you an example of that in just a minute. So that's why you have child tax credit and additional child tax credit. The additional child tax credit is a refundable portion of the child tax credit. I'll show y'all that in a minute. What's the difference? Same thing I said. But and so let me show you an example on the tax returns. Let's do this. I'm gonna take this off so we can just work on the W-2. All right, let's say for instance, on the single, we're gonna do child. No, let's do a young child. Sorry. All right. I'm going to hit save. So let's look at the tax return now and how the credits work. All right. So we know that the adjusted gross income was $50,000. Standard deduction is $14,600 based on the filing status. Taxable income $35,400. The taxes owed is $4,000. Okay. And so in 2024, the child tax credit is $2,000. Okay. And so the child tax credit that they got for that was they got the full $2,000 for the child tax credit. And so that $2,000 child tax credit went towards this $4,019 taxes owed, and that leaves taxes owed as 2019 because the credit, they got the full amount of the credit. But let's say that let's say Jane Doe only made $12,000 and didn't pay any income taxes in. All right, so if you look, the $12,000 that Jane Doe made is under the standard deduction, so there's no taxable income. There's no taxes owed. There's no child tax credit that Jane Doe qualified for. The only thing Jane Doe qualified for was the additional child tax credit, so she only got $1,425 for her child versus the $2,000 child tax credit. So the way the child tax credit works, it's $2,000, but I think only $1,500 of it is refundable. And so you don't get the whole $2,000 in a refund. You only get the rest of it towards whatever taxes owed. If there's no taxes owed, then you don't get the full credit. So she didn't get the full $2,000 for child tax credit for this child because there was no taxes owed, because this is not a fully refundable credit. But she did get the $4,089 earned income credit towards her refund, because that's a fully refundable credit no matter what her income is. If she qualifies for earned income credit, she gets that automatically towards her refund to cover any taxes, and whatever left over is hers. So that's the difference between a refundable and non-refundable credit. Okay. And there's so many other credits. We won't touch all the credits, but I just want you guys to know the difference between refundable and non-refundable. Because when we go through the tax law changes, you'll see that it was a sham, that we didn't get all the big breaks that we were told we got. You'll see we got the breaks in a minute. Any questions on refundable or non-refundable credits? Okay. All right. Let me show y'all this one again real quick. All right. So let's say, for instance, this is another non-refundable credit. Let's say, for instance, she also paid for daycare or child care for her child. Let's say she paid $3,500. That helped her refund go up about $600 because of her income. Because what happened is she got the child dependent care credit that went towards the taxes owed, and then the child tax credit that she got was only $143, and then the dependent care credit was $900, and so it covered the whole amount of taxes that she owed. And so the most that she got for in a refund was a $1,700 additional child tax credit, and then the earned income credit. Sometimes it's coming in. But if her income, let's say, let's take this off for a second. And let's say her income was $12,000 again, didn't pay any taxes in whatsoever. And I'm going to go back to this. So right now the refund is $5,514. She paid in $3,500. Paid in $3,500. I'm going to hit save or refresh. The refund did not change because that is not a refundable credit. It's a non-refundable credit. So that credit only applies and helps out if there's any taxes owed. That will be the first credit applied to the taxes to give more room for other credits to be applied and get more refunds from other credits, so forth and so on. But if the income, if there's no taxable income, if the taxable income is a lot less, it doesn't make that big of a impact on the federal taxes. So the non-refundable credits only goes toward taxes that are owed. Refundable credits, it doesn't matter. You get that in the refund period. All right, cool. Let's keep going. Cannot wait to get to this. I'm almost there. All right, so we got the credits over and so on. Let's go back to here. All right, so let's talk about the W-4 form. Let me show you this real quick. Because this is one of the biggest issues that I come across with my clients that do not pay enough taxes in. Well, I changed my W-4 form and they're still not taking taxes out right. So I'm going to show you why. When you fill out a W-4 form, of course, you put your name, information, all that in. You have to choose a filing status. Do you know that when you fill out a W-4 form, no matter when you fill it out in the year, if you don't make adjustments on this W-4 form, then the system will automatically take this as this is if you were just now starting this job. This is the first time you're earning income, and it will apply it as such if you don't put that on the W-4 form. What do I mean by that? Say, for instance, you switch jobs in June, right? And so on your new job, you're filling out this W-4 form. You put single, whatever you want to put on here. You put how many dependents you have, and that's it. You turn it in. Well, that means that they are going to assume that this is your first time making income for the whole entire year. If you made any income on any other job before this job, then automatically, I'm going to make sure, then automatically they will not take any taxes out until your total yearly income, your year-to-date income, reaches the standard deduction based on what you chose. For example, if you put single on this tax return, no dependents, the standard deduction is $14,000, not flat, but we'll just say $14,000. This means they will not take any taxes out of your check on the federal side. They'll still take FICA. No federal income tax will come out until your year-to-date reaches that standard deduction amount, which is $14,000. Because again, they have to take into account that you're not going to pay taxes on the first $14,000 of this year-to-date income. And so that's the reason why a lot of times, a lot of you guys will call like, hey, I changed my W-4 form, it's still not taking taxes out. What's going on? What's wrong? What's wrong? What's wrong? And that's the reason why. It's based on however you fill this out. They're going to assume that this is the first time. So what you would have to do is this little worksheet here, you have to actually kind of do the little worksheet thing. If you had another job early in the year, you go to this worksheet and you figure out what balance status you're going to be first, how much you made already on that job that you had before you fill this out. And it'll kind of tell you what amount to put on line 4, which will let them know, yes, go ahead and start taking taxes out on the very next paycheck because this person has already reached that standard deduction for the whole year already. And so that will avoid you having to go through the whole year not realizing that not enough taxes came out. And in your mind, I filled it out right, but I don't know what's going on. You filled it out true, but it still wasn't filled out properly based on your overall income. Does that make sense to everybody? I need to do it again.
So Carla, let me ask you,
Is
I'm
that-
sorry. Go ahead. If you only have one job and you're still not, you're they're not taking, you're not taking, say if you're head of household and you're not taking out enough taxes, how are you, I mean, what can you do to make sure? Would you have to go out there and do that calculator that they have out there on the IRS website? Is there a way to fill out that form or to put, okay, pay this much out, take this much out of each check that I'm getting? Because like I said, I don't understand this form because evidently I wasn't paying enough in, and that's why I got dinged. So that's what I'm trying to figure out. How do you properly figure that out? If you had the same job for the last some odd years, what should you be marking on this, or how should you be filling out that form?
That's a great question. So that's the next part. So again, when you fill this form out, the first assumption is this is the first time that you're making income for the whole year. The second assumption is that you were in the very first tax bracket. And so it's going to automatically assume that your income will not be over a certain amount anyway. But if this is your first, say you do it January 1, and you were set to make $100,000 for the year, even if you put single with no dependents and you file single with no dependents, it still may not be enough taxes come out because it's not going to consider in the first few times that you get paid that your income is going to be over a certain amount. And so this is where I would say get with your tax person first, kind of have them kind of look at what your projected income will be and let them help you figure it out. But just to be on the safe side, a lot of times for you guys that make more than a certain amount of money each year, are always, even if you have dependents, even if you're married or head of household, start out filing single first, and then wait for the first 2-3 checks to come through to see how everything plays out, and then make adjustments. A lot of my clients will call, we make adjustments throughout the year. You may even say, hey, I want them to take out more money throughout the first part of the year. I'm gonna get my little refund anyway. I ain't gonna really need it like that, but I don't want to pay up as much towards the end of the year for holiday time or whatever. I want to have more money on my paycheck, or I have a bonus coming up and I don't want them to kill my bonus. What should I do? And so that's where we kind of play around with the W-4 form, and it depends on your tax person, because some things I cannot say right now because it's been recorded. But get with your tax person and kind of figure out what's best for you, because it's not going to be the same across the board for everybody. But these are some things to consider when you're actually going through the W-4 form to make changes. You also can go to the IRS website and use the estimator. Like if you're not sure how to fill it out and you can't get in touch with the tax person, or maybe I'm not the tax person, whatever it is, you can go to www.irs.gov/W4app, and you can actually put in your information, and it'll kind of give you a suggestion on how to fill your W-4 form out the right way based on some questions that it may ask you. But I would absolutely say it's safe to play around with, not play around with it, but make adjustments throughout the year, because things may change throughout the year. You may have different goals. You may have a different tax goal. You may have a different house planning goal. Whatever your goal is for the year, then you need to make sure you properly plan for it. Planning is everything. And then that's not, so anybody that's on here that I'm not your tax person already, I don't have to be. I have way too many clients anyway. Love you guys though, but I still do free tax planning sessions with anybody, whether they're my client or not, and I don't have a problem giving out any information for you to take back to your tax person, and so you can actually still get the proper help as well. So keep that in mind too. So this is not a plug. This is not a plug session. This is just an information session. But
it doesn't matter what. Yeah.
Mm-hmm.
I mean, when you say, when you know, because each state laws are different. So when you say you do tax, you do tax planning people. So you just go by what state they're in, right? Because we're all in different states, right? So tax planning for California is different. You know what I mean?
Yep. Yeah. So mainly it's the federal taxes anyway. But just so you know, I do all 50 states, Virgin Islands, and Puerto Rico.
Oh yeah,
I'm
that's
licensed
right.
in all 50 states, Virgin Islands, and Puerto Rico. So I do tax planning for anybody across the country, Virgin Islands, and Puerto Rico. So it really doesn't matter. But the state taxes, we do plan for those too. But the biggest planning that has to happen is the federal, and then the state just kind of falls in place anyway. So yep. Good question. Now that was a setup for a plug. But anyway.
So, Carla, let me ask you a question. So coming up January this year, when I start January next year, is it best if I just set up a time with you and we can go over the W-4 together and make sure that I'm filling that out correctly and just based off my income? Because I usually get my raise around March of each year, and then my bonus comes out in March. We get a bonus. So what would be the best time for me to go in and update my W-4? Because I know it's a time, certain times of the year, if you wait too late, you know you're not going to do yourself any good. So what would be your suggestion for that?
I would say let's do a tax planning session before the end of the year, and I normally fill it out for my clients, and then you can take it and turn it in, but I do tell you what I'm doing. So I can fill it out for you or show you how to fill it out sometime in November, December. And then when the time comes, I can always set a reminder for you to do it at the time that I set for you to do it. Because I know when January hits, well, actually December, I'm going to be swamped. I won't even be able to take any tax planning sessions, and after we get started, it'll be just straight up taxes at that point. But I would say let's do it. And so that's what we do, tax planning session. So several clients, I've created the W-4 form, multiple W-4 forms, and had set dates for them to change them at set times. So W-4 form number 1 is for right now. Then W-4 form number 2 is for this particular date. W-4 form number 3. And so we can even do it that way to have like a set time when to change them. And they're already filled out. And then you know how the tax zone system can send you automatic reminders. I can set it up where it sends you a reminder automatically to change it, because I know me and you probably will forget, but the system can send it out automatically. We can do that. I would say let's do that.
All right. Thank you, sweetie.
Quick question. So if I wanted to get mine from my job, I would just reach out to them to get a copy so we can review it to see if I'm on track with everything.
You don't have to get the W-4 form. We can just look at your most recent check stub.
Okay.
See if you're on track with everything.
Okay, great. I'll reach out to you to set something.
Okay. But based on what we already set up for you, and Amanda, what we set up already, 2 months ago, I think you guys will be fine. Anyway. But we still can look at it just to make sure.
Yeah, I want to be on the safe side because you know my situation.
Yeah. All right. I got you. Okay. But no, that's fine. We could still set a planning session though. That'd be fine. All right. Any other questions?
Cara. Hi.
Yes.
I just had one question. So we just kind of basically are doing the same thing that we did last year with you, Jasmine, and
Okay.
Okay. All right.
Yes,
So,
ma'am.
Carl, are you gonna get to I don't know, things, write-offs, what, you know, like you had said you can't do work-related um write-offs anymore. You know, federal and state, you can't write off work-related expenses like conferences, and that's what I'm talking about, right?
Yes,
Work-related expenses.
California you can. Yes, California you can. Yes. Federal you
Okay,
cannot. No.
okay, okay,
So
okay.
let me show you real quick. So on this Schedule A, this may be a question everybody may have. Um, so on the Schedule A, at the very bottom of it, these are the only states that you still can write off. You can still itemize work-related expenses and things like that. Alabama, Arkansas, California, Hawaii, Minnesota, and New York. So those
Okay.
are the only states that you still can write work-related expenses off that will help you on your state income taxes too. All the other states you cannot, because they're following the federal guidelines versus just keeping their own stuff together.
So when you talk about rental property expenses, is
Mhm.
that state only?
No, so rental property expenses wouldn't be itemized. That would be on a Schedule E, and so that would be rental expenses. That'll still help, also, but you still need to be real careful with writing things off. Which I'll go through a rental property example when we get to that part too.
Okay.
Can you write off home office expenses if you work remotely from home? Depending on what state you're in, and that will be a no for you, Chris. um, depending if you work from home and you're a W-2 employee, these are the only states that you can still take that expense, work from home expense, on a work related side. And so that's why we do what we do for you and L, Chris, is we do it a different way. So no, not on the state side. No, not employee expenses. Mm-mm. All right. Any other questions? Said boo. Okay. All right. Let's keep moving.
Carla,
We're
you
almost
do
there
have
to the.
Carla, you do have
Hmm?
another question out there in your chat.
Let me see it. Let me see.
Hi, Carla.
It's
Can you hear
Hey,
me?
it
I
It's
said,
can.
what if you
Bianca.
are
Oh,
1099? Is there something I should get checked?
oh, okay. 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 I got you. Okay, I got you, Matt. Hold on just a second. Go ahead. Was that Megan? Go ahead.
Okay, sorry, Carla. This is Bianca, and I didn't realize I was
Oh,
on the
Bianca. Okay.
organization Zoom.
It's
But
okay.
I got a raise in September. I got my first check, a new raise and a new position. I did not notice that they were taking. I live in Mississippi. It didn't change my state. However, they changed the state. I don't know if my boss just assumed I was from Alabama or what happened, but I've been paying Alabama taxes while living in Mississippi
Mm-hmm.
for at least 4 checks.
Mm-hmm.
So if we need to have like a separate meeting, like I'm up to that. But I just wanted to know
Yeah.
what repercussions that would happen, 'cause assuming it's only 4 checks, but you know what will happen on the state level regarding that.
Nothing. Nothing will happen. Mississippi will give you credit for the taxes you paid to Alabama. You still need to change it though, but you still will get credit for those taxes that you paid to Alabama when it's time to file those taxes. Some states will allow you credit, some states won't, but Mississippi will allow you to get credit for the taxes you paid.
Oh wow. And so what happens? Like Alabama got that money, what happens there?
You'll file an Alabama return to get the money back.
Oh wow.
Well,
I'm
I will.
tired of
I will
Alabama.
file an Alabama return and get the money back. I'll just have to file two
Great.
state tax returns, but you'll get it back.
Thank you.
You're welcome. All right, Matt, you were saying if you're 1099, so I cannot remember, Matt, if we are S corp, if we moved over to S corp or not yet. But what happens is if you're 1099 only, the best benefit, especially in the industry that you're in, or that you were in, sometimes it's best to properly structure that as either a S corp LLC or self-employed and actually pay yourself wages, partially pay yourself wages through the business, which we can talk about that in more detail. But me knowing your situation, you're good. I got you. Don't worry about it. But yeah, we can still do our last minute tax planning session for the year just to make sure it's nothing that we missed. I think some things changed for you. So we can have a one-on-one just to go into more detail about it though. Oh, you're welcome. All right, so let's get to the changes real quick because I don't want to keep y'all too long. All right, so the Tax Cuts and Jobs Act happened in 2017. Let me be clear. I'm going to say this real quick, especially since we're being recorded. By no way, shape, or form is this about anything political. This has nothing to do with one president or the other. I could care less. This is just tax facts only, okay? It don't even matter who was the president at the time. Or it don't matter. This is just tax law changes, period, that you need to understand. So the Tax Cuts and Jobs Act of 2017, which we used to call TECJA, they were the most significant changes since 1980, 1986, I think it was. Some of the most significant changes to the tax law system since the 1980s. There were so many things that changed, and it was painted up in a really big bow saying, yay, we're going to save so much money, we're going to get more back on our taxes, and we're going to be able to get more back on our paychecks and on our taxes. It's going to be amazing. And when the tax returns were filed in 2018, there were so many people that were messed up and had to pay back for the first time than they ever had to pay back before. And I want to show you why. And the reason why we're going way back to 2017 is because the one big beautiful bill ties into the 2017 one. So what happened is when the 2017 Tax Cuts and Jobs Act came out, a lot of those changes were only set for 8 years. Okay. And so where would that take us? 8 years from 2017 is 2025. And so a lot of them were set to expire this year. And so when the one big beautiful bill was signed in, a lot of those temporary changes were either made permanent or they were changed a little bit or they expired. And so that's why we're going way back. But I want to show you what happened and how it messed a lot of people up and why a lot of my clients, we had to transition to a whole nother style, a whole nother format of planning our taxes. And give you a whole bunch of details on the recording, but I'll try to give as much as I can. All right, so let's look at it real quick. So the tax law changes that happened on an individual tax return or tax rate, it was still the same 7-bracket structure that I showed you guys a minute ago. And the tax rate, the top marginal rate, the top rate, it went from 39.6% to 37%. Remember I showed you guys that? Let me show y'all this real quick. This is the 2017 one. I'm just going to show you the difference in just a second. Let's see, where am I at? Tax law changes. Okay. I'll show you real quick. So this was 2017, okay? So 2017, the tax rates were from 10% to 39.6%. 2018, it changed from 10% to 37%. So the only significant change was only about 2 to 3% max on each tax bracket. So it wasn't a big change, but it was a change, and everybody was cheering for it and saying, "Oh, yay, we're gonna be amazing." So what happened? The standard deduction was doubled, and then of course head of household filing status rules changed as well. This is where before you could not file head of household unless you were claiming a dependent on your tax return that was either a sister, brother, niece, nephew, son, or daughter. And that was the only way, or sister, brother. That was the only way that you can actually file head of household as far as the status goes. That rule changed. I love this rule. This is a beautiful rule. The rule changed. And so it's also, you can still file head of household if you're not claiming a dependent as long as you have a qualifying dependent. What do I mean by that? Say, for instance, you have a couple. They're not married, but they live together. Okay? And they have one child together. Well, the woman may make less money than the man, not because she's a woman, just don't do me. And so, say, for instance, he pays most of the bills, and she, works and takes care of the child. So when she files her taxes, she may file single and claim the dependent on her taxes for the child tax credit and earned income credit. Well, because the child is his, and he does pay most of the bills, or have more than half the bills of the household, he can still file head of household and get that extra standard deduction to help him on his taxes, even though he's not going to claim that child as a dependent. And it does not affect her taxes. It doesn't affect his taxes. Let me show you this real quick. So what this looks like. Say, for instance, you have, and this is where a lot of guys, this helps a lot of guys as well, women too. It helps a lot of grandparents too. You may have where, something may happen. You have more than one family living in one household with the grandparent. They have to move in with the mama, and the mama's taking care of the whole household, paying all the bills, and the daughter has kids that's staying with the mama, or the son has kids staying with the mama. The mama's not claiming any of those dependents, but the mom still can claim head of household because she's paying more than half the upkeep of the home, while the parent of the child claims the child as a dependent. So let me do this real quick. Okay, let me change. All right. So let's say we got 12,000. Say John or Jane Doe made $45,000 for the year, paid 10% in, which is not enough, but still, whatever. And filing single, the refund is $1,081. Change the status to head of household only, the refund goes up to $2,056 just from filing head of household. And on the 1040, you will see where it says head of household, and you put the child's name and social security number here. And that's the only information that will be needed. And then Jane Doe files head of household without claiming the dependent on the tax return as their dependent, but a qualifying dependent that they're not claiming on their tax return. And so, let's see real quick. Components. No, it's not. Oh, it's a training return. I can't show you. But anyway, on the actual tax return that's printed out, it'll say head of household claiming dependent child that's not a dependent or not being claimed on the tax return. So it'll actually say that this child is not being claimed as a dependent. And so a lot of people had no idea that that change was made in 2017. And so a lot of people have missed out on a whole lot of money. I had another client was owing money every year, not much, but was owing at least $1,000 something every year from a divorce, whatever, had a divorce. Their child is in college. He helped to take care of the child. Neither one of them were claiming the child as their dependent, right? But this child is in college and both take care of that child. They don't live together. And so he can claim head of household and put the child down as a qualified dependent that he's not claiming to get the head of household filing status. And so can the mom, the divorced mom, that pays half the upkeep of her home. And she's not claiming the child is dependent on her taxes either. And they both are getting the head of household credit because head of household only means that you're paying more than half the upkeep of your home. There's a flip side to the head of household filing status. Even if you have someone that has, a child or children, they have their own apartment or house and things like that, you cannot file head of household if you are receiving any type of public assistance or government assistance like food stamps or housing assistance or things like that, because they're saying that because you're not paying more than half the upkeep because they're paying for the rent or they're paying for the food, so forth and so on. So it's a sticky situation. And so you have to be really careful when you're filing that. But again, what if Jane Doe made as head of household filing status is $21,900 standard deduction. If the income was under that, it doesn't matter whether you file head of household or not, because it's not going to make a difference because the income is under the standard deduction anyway. And so that's another rule. So we have to be really careful as tax preparers. That is a very old change. That change happened in the 2017 Tax Cuts and Jobs Act. So right now we're going through the changes of the Tax Cuts and Jobs Act because a lot of that still is prevalent with the Dick Beautiful bill. And so that helps a lot of people. You may have grandparents that actually are able to file head of household now because of that rule. You have aunts and uncles that now can benefit from that rule depending on their situation. If they do help with that child, but they can't claim the child in their taxes, blah, 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 grandparents, so forth and so on. See, how does that work for retired grandparents with kids and grandkids? It depends on your income. And so for retired grandparents, it depends on what type of income you have, whether or not it helps. But again, it's not a credit. It's a filing status that allows your standard deduction to increase to take away the taxable income. And so it absolutely can help depending on your income, because of course you can have more deducted from your total income that you don't have to pay taxes on just by changing your filing status. And so it absolutely can help for sure. So that's one of the things that I did like about the changes. Another thing, the child tax credit expanded to $2,000 instead of $1,000, but the only amount that you can get was up to $1,400. And so even though it looked like the child tax credit doubled, the refundable portion of that credit only went up $400. So it wasn't a big. It looked like it was a big change, but it wasn't. Then another thing that I liked about it, there was a non-refundable credit that was added that we did not have before, and that's something called the other dependent credit. And so for this particular credit, say you have someone that's living in your house that you've been taking care of that's not a relative, but they're not working or whatever, but you've been taking care of them, and you normally wouldn't be able to claim them on your tax return because they're not related to you. This is where you can get a $500 credit, non-refundable credit for them as an other dependent, cousin, friend of the family, whatever. You can get the other dependent credit for that person when you would not have been able to get a credit before. But again, it's a non-refundable credit. So no, your grandpa and your grandma, if they're married, it would help if they filed a joint return versus a dependent. And we'll talk about the dependents, how the dependents work in just a second. And so they would file a joint return to get a bigger standard deduction when they file a joint return. Okay, and then of course with the One Big Beautiful bill, the child tax credit went up from $2,000 to $2,200, and they made that permanent, and it's up to $1,700 refundable, which was what it was already anyway. So it didn't really change. And so on paper it looks like, oh, we're getting more money. No, you're not, because it's not fully refundable. It's like a lot of smoke and mirrors, but I'll show you smoke and mirrors in just a minute. And then itemized deductions were limited drastically limited. And so a lot of people, so let me say this, a lot of people that were affected, I don't say hurt, a lot of people that were affected by the 2017 Tax Cuts and Jobs Act were the middle class. Because for the most part, a lot of middle class people were able to itemize and get way more for the itemizations than they would have normally gotten back before, because they were able to write off moving expenses, any type of work-related expenses, property taxes, mortgage interest, all those things were helping, right? And then what happened, all of that was taken away. No longer can you write off anything work-related, period, on the federal side. Nothing. No work from home, no moving expense, nothing. Chris, y'all remember, especially when y'all were in Mississippi, like it was a lot of y'all that were having to move different places because of the type of job, and you were able to get that credit for moving. All that went away. And so also there was a cap, which wasn't a cap before, but they put a cap of $10,000 cap on state or local tax deduction. And then also on the mortgage interest deduction part, it was also limited to the interest on the first $750,000 of a new mortgage. It was $1 million, but they dropped it down to $750,000 mortgage. And so there was a lot of things that kind of was taken away. Another thing that was taken away, the personal exemption that everybody qualified for, that was taken away. What is the personal exemption? So on top of the standard deduction in 2017 and beyond, before that, on top of the standard deduction, you were able to get a $4,000 and something dollar, like just say $4,000 credit for yourself, your spouse, and all your dependents. That was automatically deducted from your total income on top of your standard deduction, which also lowered your taxes. That does not include earned income credit or child tax credit. And so a household of 5 people would benefit drastically the way it was in 2017. And on top of that, and itemize yourself. Now the only difference, let me put this on let me do paintbrush. Let me show y'all this on paper. So we'll just say what this means. All right, so we'll say 2017 over here. Okay. It's 2017. The standard deduction, say, let's just for round numbers, was $6,000 for the standard deduction. And the personal exemption for each person was $4,000. Okay. They took the exemption away, period. But then they also doubled the standard deduction in 2018. Okay, so let's say 2018. Standard deduction is $12,000, but no personal exemption. Okay, so that means for 2017 income tax, this person would have gotten a $10,000 deduction total versus a $12,000 deduction in 2018. But that means this for 2017, property taxes, mortgage interest, work-related expenses, moving expenses, car tax, charitable contributions, medical expenses, all that. If it was more than $6,000, then that would actually deduct even more. So basically, what I'm saying is, if they had just $2,000 worth of itemization, it would equal to this $12,000 anyway. But doing it this way, 2018 way, it puts everybody in a box, and they can't exceed the standard deduction. And so, say for instance, this person is filing single and has 2 dependents. So this person would have a $6,000 standard deduction, $4,000 exemption for him or herself, and then $8,000 total for 2 dependents, which gives them an $18,000 deduction versus it being a $12,000 deduction for 2018. Because no longer can you write anything off as far as standard deduction, itemized deductions, things like that, that will equal $12,000. It was almost impossible to come up with enough itemized deductions to exceed the $12,000 that they put everybody in a box for, especially taking away that exemption. So on paper, it looked like it was going to help more people, but if you go back and look at a lot of the news articles, you had so many people complaining, people that had never had to pay in ever before. They were having to pay in for the first time ever in 2018 because the way everything was structured, the structure changed. Another thing, the tax brackets were adjusted without anybody knowing anything. And so remember, we looked at those tax brackets and the standard deduction and single and all that stuff on your W-4 form. When they start taking taxes out, when the changes happen, they start taking less taxes out of your paycheck because the tax brackets adjusted without you knowing anything. And so when you got your W-2 in 2018, you paid in less taxes than you had paid previously. On top of that, now you're stuck in a box of the standard deduction and you can't itemize anything anymore. And the smoke and mirrors of more tax credit, which you did not qualify for because it's not fully refundable, it put everybody in a box and it limited the amount of refund that you can get. Yep, it would help, Matt. You need to claim her as to get the other dependent credit for her for sure. Yes, but anyway, so there was a lot of smoke and mirrors with the Tax Cuts and Jobs Act. The problem is those things were supposed to expire this year, and they have been extended. So we'll talk about some of the extensions and how to actually offset it. And so this is the difference between the tax rates or things like that. So we only got a 2 to 3% deduction of income tax rate for us as individuals. Did you know that the corporate income tax or the business taxes on all these corporations, theirs went from a 35% rate to a flat 21% rate, and that was made permanent in 2017. So they got a really big tax cut. On top of that tax cut of it going from 35% to 21%, whatever income that they did make, they also received a 20% deduction under qualified business income deduction on top of that. So if the corporation made $100,000, they automatically get to deduct 20% of that, which takes it down to $80,000. And then that $80,000, once they have all their expenses, instead of them being taxed at a 35% rate, they're only taxed at a 21% rate. So they're only paying 21 taxes on 80% of their income after the smoke clears. On top of that, the depreciation of a lot of assets and business assets and things like that went up to where you can depreciate 100% of the actual asset under the special depreciation of Section 179. What does that mean? Previously, businesses, if they had a car, business car, whatever, they could only deduct a certain amount of the cost of that car per year, and it had to be stretched over a certain period of time. So this would allow businesses to actually take 100% deduction for the car that they bought. Say they paid $30,000 for a business car, they can deduct the whole $30,000. That comes off the adjusted gross income. And so they're only going to pay 20% of what's left over, and then only 21% of, 80% of what's left over, and then only 21% of that. So the whole point, the Tax Cuts and Jobs Act, where there was so much smoke and mirrors, it's going to help so many people. It did help a lot of people, but it wasn't the individuals. The corporate side saw the biggest tax rates ever since 1980.
Wow.
They were supposed to expire this year in 2025. The One Big Beautiful Bill made those permanent. And they also made permanent that we don't have a personal exemption anymore. That's permanent as well. They are going to still continue to increase the standard deduction. But another change that was made with the Tax Cuts and Jobs Act that has been made permanent on the Big Beautiful Bill, on the corporation side of it, they've changed it from a worldwide tax system to a territorial system. What does that mean? This means that any U.S. corporation, if they make any type of foreign dividends or make money off of any other foreign country, they don't have to pay taxes on it anymore.
Wow.
How is that going to help us? How is that helping us as individuals? It does not. And so when we went to, my husband and I went to Atlanta to go to the IRS conference there, because we used to go to them all the time. And when they made the rollout and they were talking about all the tax law changes, it was like at least 1,000 other taxpayers in the whole room. They start cheering and like, yay, yay, yay. Oh, wow, it's going to be amazing. And I don't know what happened. Like, I was so confused as to why everybody was cheering. I got emotional. And I looked at my husband, I was like, do you see what's going on? This is terrible. He was like, I'm not lying to you. I don't know what the hell's going on. I don't do taxes. I have no clue what's going on. He was just playing Candy Crush. He had no clue what's going on. But it took me at least a month or two to like stop tearing up every time I would think about it, because I knew it was going to hurt so many people, and people had no clue, and so they couldn't plan for it. And so I want to show you what we did then and what we're going to still do now to help offset these things, since we can't do anything about it. Another tax, I didn't put this on the screen, but another change that the Tax Cuts and Jobs Act did, and it was made permanent with the One Big Beautiful Bill, is the real estate industry got a lot of tax breaks, because at the time, the current administration, that was one of the main businesses that the current administration had. So I get it. I would have probably did the same thing. You know what I mean? Like, whatever. But what was shocking to me is at that time in 2017, there were certain contractors If they build anything in any certain areas, if they build any projects or whatever and made money from building projects in certain areas, they would not have to pay any taxes on the money they made building in certain areas, right? One of those areas was in the area where the wall was supposed to be built. So that means whoever was going to build the wall and get paid for building the wall would not have to pay taxes on it. How the crap is that going to help us? What? How's that going to help us? Another thing they did, they increased the amount that you can write off for charitable contributions to $1 million versus whatever it was back then. What middle class donates $1 million? How does that help? That wasn't helping us. I don't want to get emotional because this is going to be like a recorded thing and I'm going to post it. So I don't want to give too many. I'm going to go one side or the other. I'm just giving you the facts. And so the biggest tax breaks that happened were for the big corporations and things like that, while the middle class were forced to fund the rest of everything else. I'll say this at this point. This is just information purposes only. This is what I have been looking at. Since 2005, you can look it up. Since 2005, this is not Democratic or Republican. Since 2005, they have been trying to employ, let's say this on recording, let me think. They've been trying to employ a certain type of tax system, right? It's called the Fair Tax Act. You look at the Fair Tax Act. What that means is, and they've been trying to get rid of the current tax system that we have. That's why it's been a whole bunch. When y'all see the changes with the overtime that everybody's so happy about, we don't have to pay taxes on overtime. Y'all gonna be like, what is this? Get this out of my face. You know what I mean? Like that's like somebody saying, hey, I know you need a little bit of help. I got something in my pocket for you. I'm gonna give you something to help you out real quick, and they give you a penny. Thank you for the penny. What is that gonna do for me? It's the same thing, and I'll show you in a minute. So the Fair Tax Act. So what that means is if they get rid of the current system, which they keep getting rid of the IRS. The IRS has never taken your money. Your money does not fund the IRS. The IRS is an accountant for the federal government. Your funds go to somewhere else, but they are the ones that are supposed to regulate. Who cares if you get rid of the IRS? That means absolutely nothing. You still have to pay somebody something. The Fair Tax Act means that instead of the current tax system, which is FICA taxes, FUTA taxes, and then state and local taxes and things like that, right? FICA taxes are your Medicare and Social Security taxes that come out automatically on your W-2 no matter what you choose to do in your W-4 form, something that you cannot change. FUTA taxes are your unemployment taxes. That's something that's automatically as well. Okay. And then you also have state and local taxes. Well, the FICA taxes, Medicare and Social Security taxes, fund certain governmental projects like Social Security benefits, Medicare, Medicaid benefits, things like that. The unemployment insurance taxes, that covers, unemployment, some other things like that. Your income taxes on the federal side funds all the federally funded programs like Department of Education, the post office, any federal type of industry, like any federally run program. That's where the income taxes fund those projects, right? Now, when we had the changes come around in this last election, again, this has nothing to do with politics. I'm just giving you facts. When there were supposedly billions of dollars found in fraud with the Social Security, they were going to try to get rid of that, get rid of Medicaid, get rid of the Department of Education, all these different departments being dismantled, all these federal employees losing their jobs. That is gearing towards being able to say, yes, we no longer need the tax system that we need, because what was stopping since 2005, what was stopping them from employing the Fair Tax Act, they could not justify not needing the current tax system that we have because it funds so many programs. But when you start getting rid of those programs, now you can say, yes, we don't need those funds anymore because those programs no longer exist. We can do the Fair Tax Act now. What the Fair Tax Act is, you don't pay any income taxes anymore or any payroll taxes or FICA or anything like that anymore, but you would have to pay a 21% sales tax on all goods or services on a federal level on top of your state sales tax. Mississippi, our state sales tax is 7%. that means we would have to pay a 28% sales tax on everything that we buy, goods or services. And that money would fund the rest of the government that's left over. Now, the ones that are exempt from paying the fair tax, the way they have the system set up now, if they do employ it, are those who are making business purchases. And so if you make a business purchase, you're exempt from paying that fair tax. And so what that means is corporations, if they do employ it, will be able to make as much money as they possibly want to make and will never have to pay another income tax, sales tax, employee tax ever again. All their money will be tax free, and the rest of the government that's left, federal programs that are left, we would have to be the ones paying for it through that sales tax. And so with that being said, the things that we've been doing since 2017 Tax Cuts and Jobs Act will take a big play if that does happen. We're not talking about doom and gloom, oh no, it's over. No, we're just properly plan. That's all. And so that being said, I'm going to show you guys how to actually maximize your taxes, because we've got a couple more minutes to maximize your taxes to the best of your advantage, just to make sure that you're saving on taxes, you're maximizing your refund if you get a refund, and you're also keeping your buying power with the banks as well, just in case you need to use your tax return for something else. And so let's look at these changes again. So One Big Beautiful Bill Act took the maximum tax deduction permanently from $1 million to $2.5 million. What does that mean? And One Big Beautiful, so in 2017, the most that someone can deduct from their taxes was $1 million. And so the Big Beautiful Bill changed it to $2.5 million that you can deduct. How the crap is that helping any of us on Zoom? How? What difference does that make? You don't make enough. You don't even make enough to take $1 million from it. You know what I mean? So that was another thing that was put in place with the One Big Beautiful Bill. So the elimination of the personal exemption that we talked about is permanent now. We will not, because it was supposed to expire. We were supposed to get it back in 2025. But they made it permanent. We will not get that exemption back. And then some of the new temporary deductions that are right now because of the Big Beautiful Bill. I like this one. The senior deduction. Anybody 65 or older can claim an additional $6,000 deduction, but it was already like that anyway, the standard deduction. But they said that's a change, but it was already like that anyway though. But they're putting in the Big Beautiful Bill to press it up, make it seem like this is something new. But seniors already had a higher standard deduction anyway. I think it was just a little less than $6,000 though. But anyway, deduction up to $12,500 for qualified overtime compensation. And this is the part that knocked me out. So I was like, okay, that's going to help, a lot of people. One of my sons, he works a lot of overtime, so he won't have to pay taxes on it. Ooh, how's this going to roll out? So this is how this works, right? So it's up to $12,500 qualified overtime compensation, and it's $25,000 for joint filings, right? But it's subject to phase out. So what this means is it's only the premium portion of overtime that's deductible. What does that mean? So the premium portion of overtime is the half part. Like say for instance, your overtime is time and a half. You can only write off the half as a qualifying premium portion of overtime deduction, right? And I'll show you an example in a minute. And it phases out for $150,000 income earner filing single or head of household, or if somebody filing jointly, it's $300,000 for the total income. And so if you make over $150,000, you can't write off any of your overtime anyway. If you're filing single or head of household, if you're filing a joint return, if your overall income is $300,000 or more, you can't write off overtime anyway, which sucks. I have a lot of clients that make over that much money and do indeed for overtime. Again, the overtime wages are still subject to Social Security, Medicare taxes, FICA, unemployment taxes, and state and local taxes. So the only deduction would be on the federal side. Let me show y'all this real quick. So this is an example, okay? Say, for instance, the regular pay is $20 per hour. The overtime rate is time and a half, right? And so that will be time plus half of that 10. So you got $30 per hour is what the overtime rate would be. Say, for instance, you work 50 hours that week. And so the regular pay is 40 hours times $20, which is $800. And then the overtime pay of those extra $10 is 10 hours times $30, which gives you $300 total for overtime. In this scenario, though, the total overtime pay is $300, right? But that's composed of your regular tax portion of 10 hours times $20, which is $200. And the premium portion is 10 hours times $10. And so the only amount that you'll be able to write off or that's eligible for that would be the $100 out of that whole entire $1,100 check. So even though you worked overtime, made $300 on overtime, you don't get to write off the whole $300. You only can write off the halftime portion of that overtime check, which will be $100 in this scenario. Does that make sense to everybody? I'm going to do it again.
So we get this basically at the end of the day, what he put out there really doesn't benefit any individual. This is mostly all for corporations. That's my understanding.
Yep, you could say that. Well, there are some benefits, but they're just not major benefits.
That's what I'm saying.
There were some changes. Yeah, there were some changes, but it just wasn't anything that it wasn't enough for us to be like, oh yay, we're getting so much help. Oh wow, that's amazing. Oh yay, it comes pretty much comes. But there's still a way around it. So I'm going to show y'all how to maximize this real quick. Okay. Let's see. I don't even know what the next slide is. Let me see. We talked about the income tax brackets already. I'll show y'all the new income tax brackets then. All right. So these are the ones for now. So 2025, this is our rate now, right? 37%. When they get the whole 21%, that is crazy. It's crap. All right. So let me show you this couple of examples real quick. So what does this mean for us? How do we help ourselves then? And so since COVID, the IRS stated that at least 1 out of 3 people has some type of gig or some type of side hustle, which is pretty much true as far as I know. And so with that side hustle, that is, if you make money with some type of side hustle, that is considered gig income, which they have something called a gig economy with IRS now. And so the way the gig economy works, and I'm going to show you how to keep your buying power. Let's just say John Doe made this $45,000 and single, no dependents that we're claiming. And so John Doe made $45,000, paid in 10% of that $45,000, which was $4,500. And John Doe said, you know what? I'm going to get me a little side hustle on the side, whatever it is. It doesn't matter. But I like to tell my clients to make sure it's something that you're already doing anyway, because who has time to do anything extra these days? We're building treasure cities. We ain't got time. So, for example, say for instance, every year John Doe and his family takes a lot of like 2-3 vacations a year. John Doe got with me, did a tax planning session. I was like, you know what? You should actually book the travel and let your family pay you to book that travel. If John Doe is getting paid to book travel, and he has 3 different trips that he, paid to book travel, right? And so say the whole trip is $1,200, and 3 of them going. He pays his $400. His 2 family members give him $400 each, and he books the whole $1,200 trip. He just received $800 worth of income to book travel. He may not have made a profit, but he still got paid to book travel. They were going to take those trips anyway. But because he's turning his hobby into a business structure, and now he can actually, look to get paid to make money off of booking travel, by law, technically, that makes him a travel agent because he just got paid to book travel. And so because of that, let's say he made $800, he got paid $800. Now, because he's taking this vacation, he cannot write the whole entire trip off, but he can write off the portion that he had, what it cost him to book their travel, which was $800. So he can write it off as travel, and a portion of his $400 that he paid for travel too, right? So let's just say he writes off the $800 that he paid. By law, he also, remember the income right now is $45,000. Okay. By law, he also has to have car insurance. Now because he has his side hustle and he's making, income with a side business, he has to use his vehicle to do this. And so now a portion of his car insurance becomes tax deductible. And so his car insurance, say $120 a month, we'll write off, say, half of that. All right. And so that leaves us $720 worth of car insurance. He has to use a cell phone. He's got internet that he has to book the travel on. He has a vehicle that he uses. Let's say he says, okay, you know what? I'm going to buy a house next year, so I don't want to write too much off because I want my adjusted gross income to stay high enough. And so we say, okay, you know what? Let's just depreciate versus writing a lot of things off. He has a 2024 Ford F-150 Raptor. All right, and let's say he paid $80,000 for this Raptor. I know they cost more than that, whatever, but $80,000 for this Raptor. We're going to do a special. We're not going to take the special depreciation to 100%. We'll depreciate a portion of that Raptor. And so the depreciation amount that we get, $12,400. The refund just went up drastically. The AGI dropped though. Okay, so the adjusted gross income has dropped because we're writing off these items, right? And so when it's time to go for a loan and you're getting ready to buy a house, the depreciation is added back to the adjusted gross income. And so with the $31,880 of adjusted gross income plus the $12,400 depreciation, the adjusted gross income is still $44,280, even though she's only paying taxes on $31,880. And so, of course, the side hustle absolutely helps. And so, when Jane Doe could not have written, oh wait, let me try real quick. And so, because Jane Doe could not before write off her internet and things like that because she works from home, now because she has a side hustle and side business, now she can write a portion of it off as far as a write-off on the business side. So anytime you're self-employed or you get a 1099 or you have some type of side hustle or some type of side gig, it goes on a Schedule C, which is profit or loss for a business. You may not even have a business. You don't have to, but that's just what the form is called. You don't have to have a business name. You don't have to have an EIN number or anything like that. But if you do make any type of money on the side, you do have to file on your tax return by law. And if you have to have that, so, the income, then you have to also have things that you can actually write off that cause you money to try to make money. Because the rule is this: you don't have to make a profit, but you do have to pursue a profit, right? And so no matter what it is, but let's say this. Say you're a grandparent and you keep your grandkids, right? And your child may throw you some money every time you keep your grandkids. They may give you $100 here, $200 there, whatever, to keep your grandkids. That's income. And so now you can actually use that income that you got paid for keeping your grandkids. You got $1,200 for the whole year. And now you can actually use that income to be able to have more things that you can write off that you wouldn't have been able to write off before. You can even write off, if you're keeping your grandkids, you can even write off, some of the snacks that you have to buy for them. If they are, on the couch and watching TV because you're actually, this is actually business income for you now, you can depreciate that TV, depreciate that couch, so many things, because you also have to use your vehicle. You can even write off your car repairs and maintenance. Some people, especially 299 people, always ask the question, well, should I do mileage or should I not do mileage? I always say no to mileage unless or until the vehicle is fully depreciated. And even at that point, we do something else about that anyway. The reason why is because when you claim mileage, you can no longer claim fuel, car insurance, or car repairs or maintenance. You only claim mileage, and in most cases, mileage is not added back to your income to help your adjusted gross income. But you can depreciate the vehicle and still write off car repairs and maintenance, car insurance, and fuel as well. Now, say you have the same car and you fully depreciate it and depreciation goes away. At that point, then, you may say it's time to get a new car. You know what I mean? It just kind of really depends on your tax situation. Because you have to use your cell phone to also book travel, whatever it is you're doing, you can actually depreciate that cell phone device. Most of you got those $11, $12 iPhones. You can depreciate that. That helps take off of the taxes that you owe, but it also helps you keep your buying power too. So there's a whole bunch of different things that you can do. Also, if you have rental property, or say you have your child that lives with you that's paying you rent to live with you. That's income, and so you can actually claim that it's income on your tax return as well, and you may have other things that you want to depreciate as well. So, say for instance, you receive $5,000 for the year, you can actually write off different things like that. You know, of course, repairs and maintenance of the rental property or the house that you're renting out. You can actually depreciate the house. You can depreciate the vehicle that you use to check on the house. Taxes, interest, if you still owe on the house, the interest also is added back to the adjusted gross income as well. And so all those things will actually help offset, because all of the deductions and the write-offs and the benefits are on the business side now, ever since 2017 Tax Cuts and Jobs Act. And so that's why I've been advocating for a lot of my clients to get something on the side, do something on the side, do a whole bunch of somethings on the side, not only just to help them in taxes, but of course you can actually use some extra money too. You know what I mean? And because it makes a big difference. I'm going to say this in closing, and then I'll take questions. With the economy going the way it's going right now, I would definitely strongly say, I'm sorry, I'm keeping everybody mute for just a second. Give me just a second. With the economy going the way it's going right now, you guys saw what happened with the food stamps and things like that. It hasn't been signed in yet. I wouldn't be surprised if it did get signed in, but another thing that they're trying to do right now, and they're trying to pass it before January. If they do pass it, come January, anyone who has been on Section 8 for more than 2 years will have 60 to 90 days to get off of Section 8, depending on what state they're in and what their state requires. That means there will be a lot of people who will need housing. And so if you look up any type of industry that thrived during a depression or recession and things like that, real estate is one of them, because people still have to have somewhere to live no matter what the economy does, right? And so if you are thinking about investing in something or starting some type of business or whatever it is, that would be something that I would probably say be something to look into. As far as that goes, you have a lot of different, like for example, Mississippi, they're going to stop doing income taxes in Mississippi, state income taxes for Mississippi in the next year and a half, I think it is, 2 years, whatever it is. And so you'll have a lot of people from Louisiana and Alabama moving to Mississippi to live in Mississippi and work in their bordering states if they went, you know what I mean, type of stuff like that. So those would be some good things to look at as far as investing those. But whatever it is, just make sure you get with whoever you do your taxes and try to do tax planning before the end of the year. Look at your most recent check stub to make sure taxes came out properly. If you notice when you filed taxes this year, you didn't change your W-4 form at all, and then there was still something different or weird about your W-2 that you had no clue why. Like, I don't know why they didn't take enough taxes. I didn't change anything. I don't know what happened. Well, same thing happened in 2017 as well. And so just be mindful of your tax situation. Try to do the most tax planning that you possibly can with whoever does your taxes. Again, I do free tax planning. Even if I don't do your taxes, it won't hurt my feelings at all. But I don't have a problem doing any tax planning with anybody. So what we do, we look at the most recent check stub and kind of use our software to kind of give a guesstimate of what you will look like. And if there's any changes that can be made, then we try to make them before the end of the year, just so you'll be okay when tax time comes around in the next month or so. All right. Cool. All right, cool. Any questions?
Carla, I was really happy to hear you say that about, because I am building, it's just about done, a little house in Louisiana that I plan to rent out. So my question is, it's just about done. And I am going to set up a time with you, and I may want to move forward with you because, you don't just want to listen to what people say. But I was told if I have someone in there by November and December, I can write off the whole year of all my expenses associated with this rental because, all the expenses, getting the
Mm-hmm.
lights, I'm going to have income as of, they said if I have income for 1 month, I can write off the whole year expenses
Mm-hmm.
associated with
Yep, that's
having,
true.
okay. I'll follow up with you. I don't want to waste other
Okay.
your people's time.
No, it's fine. Go ahead. It's fine.
Carl, I don't have a question. I have a comment. Thank you so much for this. I learned a
You're
lot.
welcome.
I truly did. I wrote down a lot of information. I'll get with you later. But thank you so much for this. And I appreciate it. And y'all have a blessed night.
Very
Me
good. You
too,
too. Very good.
Carla. Thank you, Carla. This was truly a
It
blessing.
was. It
We were
was.
just really blessed to have you to have done that. So just to let you know, it's so appreciated. Thank
It
you.
is.
You're welcome. You're welcome. I would say this too, though. You don't necessarily have to have rental income to be able to write off the expenses that you spent this year, though. Just so you know.
Oh,
So even if you
good.
don't have anybody renting it out by the end of the year, you still can write off your expenses.
Oh,
As long as
okay.
you have it placed in service by the end of the year, it's like it's ready to rent by the end of the year. Even if you don't have anybody in it, then you can still write off the expenses and things like that. But if it's not ready or placed in service by the end of the year, then no. But if you have it ready by the end of the year, you can write
Um,
off your expenses without having income.
yes, I'm it's gonna be ready. I have someone who's agreed. I'm gonna do Verbo and something else, but short-term rentals.
Mm-hmm.
But either way, I will have someone in there, at least some income for at least 1 month, which is December.
Okay.
But I plan to get to Meridian. I certainly want to come and visit you all, and I'm going to be, coming down there even more often now that I have this, because it's also so I have a place to stay when I come. I'm from Baton Rouge, so.
Mm-hmm. Okay.
Mhm.
Very
Carla,
good.
are you
And
able
so
to send this recording out to our email?
I will try. I more than likely I'll post it on my YouTube channel too, just in case. But
Okay.
I can try to send out to the email. But it'll be on the TBA Tax Group YouTube channel as well. We're gonna post it probably tonight or tomorrow. I'll post it because I didn't say anything that I can't post. But if you do want to, so the tax planning sessions are virtual. It's on Zoom, and so you don't have to come physically to me to do a tax planning session. It's still free. And so if you go to the website, this is the website here, and click on I think appointments, you should be able to book a tax planning session, a virtual one, and we'll just do a Zoom, and I can record the Zoom and
Child, the
send you the
folks that
recording of the
booked
Zoom.
them. The folks that booked the appointments, Carla, they gone.
What?
Trying to be slick, say,
Okay.
let me get me one in real quick. No, ma'am, they're gone.
Okay. I'll open it up. I'll open up some more availability by the end of the night, so you'll be able to. By tomorrow, you should be
I
able to
just
book
booked
more
mine.
tax planning sessions. Okay, good.
I just booked
Good.
mine.
Carla, I have a
I
question,
got it for
dear.
this week.
Oh yes, Felicia, what you got?
Yeah, so okay, I remember talking with you. So I have an LLC that I think 1 year, I can't remember if I filed it as an S corp or a C corp. I've heard that if you do that, then you must pay yourself by the end of the year. Is that true?
Yes, if you have an S corp, you have to pay estimated tax payments and or also W-2. At least one person in the S corp has to pay themselves wages through a W-2 system where you're paying FICA taxes on income. Yes.
Okay, so if because I remember again you saying that I have an LLC, each year can I decide if I want to do an S or a C corp, or do I
Yes, you
have to
can.
do it once I do it once, I have to keep doing it?
No, you don't have to. You can always change your filing status. Not
Okay.
filing status, your tax structure anytime you want to, depending on the income though. So whenever you have an LLC, I'll tell anybody it's based on your overall income anyway, or the income that you project to make is the way that you should structure it. If you don't plan on after the smoke clears and you have all your expenses paid, if there's nothing left over, if you're taking a business loss, it makes no, You don't have to do an S corp. You can actually just file it as a Schedule C on your individual tax return and just take that loss. If you see that your business is making a lot of money and after you pay all your expenses, you still have money left over each month, or you still have money left over, then at that point, you probably need to start paying yourself and switching over to an S corp, because the difference between an S corp and a corporation, you're double taxing yourself. You're paying taxes twice. An S corp is a pass-through entity where you're not paying any business income taxes or corporate taxes on the business income. It passes through to go on a personal side versus you paying a corporate tax. For example, if the business makes $100,000 and you have $80,000 worth of expenses and write-offs, you have a $20,000 profit. As a corporation or an LLC, you still have to pay income taxes and also self-employment taxes if you haven't doing a Schedule C. But then you also have to pay state taxes. But if it's an S corp, that $20,000 passes through that entity, and it goes over to your business taxes, where you're taxed at a lot lower rate than you would have if it was a corporate tax return. So it just really depends on the structure, the type of business, the type of income, as to how you should structure it. And our clients, we walk through every quarter, maybe twice a year, depending on how their business is growing, sometimes every week, until we get the structure down the way that we need to get it based on the influx of the business. You know what I mean? So we kind of keep our eye on it throughout the year. So I would say it depends on the income structure, things like that, whether you need to switch or not.
Okay, thank you.
You're welcome. All right, any other questions or comments?
So, hi, Carla.
Hey.
The you know the website that I have on there that we went through last year to do the taxes? I forgot my password, so I just got to make a new password.
Oh, okay, I can reset it for you, and I'll send it to your email to reset it for you.
Oh my! I might have to buy some more data. I ain't getting none of my emails. That thing is clogged up.
Oh, well, just create a new email, and you just use it. I could change your new email.
Okay.
Mm-hmm.
All right, I'll get in contact with you. Thank you. This has been great.
How do we make an appointment?
Good information.
How do we make an appointment for consultation?
So you go to the website, it's TBATheBostonAgency.com, and click on appointments, and you should be able to find the tax planning session or business consultation. You can choose either one. I think business consultation is 30 minutes, and I think the tax planning session are like 15 or 20 minutes. But you can go to the website and book an appointment, virtual appointment. So Vincent, I won't be doing it again because we're actually going to start doing taxes in December this year. Because this will be the first year that we're going to do the December dollars, where we'll allow our clients to get some loans in December, and then also again in January to help out with all of the things that's been going on with funds being cut and food stamps being cut. We're trying to give our clients an opportunity to get as much money as they can up front for their taxes. So we're going to open up a lot earlier this year. I won't be able to do another Zoom, but I have recorded it, and I will post it on our YouTube channel, which is TBA Tax Group on YouTube. And so you'll be able to watch the whole entire thing on YouTube sometime tomorrow. All right. And again, if you guys want to do any type of tax planning or business consultations, go to the website, TBA Tax Group. I'm not TBA Tax Group. Well, you can go to TBATaxGroup.com or TBATheBostonAgency.com and click on appointment. And schedule it that way. If it's booked, if you can't book an appointment tonight, they probably have booked them up already because my clients be doing that. I will open up more appointment availability tonight. So check back tomorrow. If you can't book one tonight, check back tomorrow. You should be able to book one tomorrow. Yeah, it is November. A lot of my clients start booking appointments around this time, so I'll open it up for more appointments. And again, if you got my cell phone number, just call me or text me. And then we can get something set up too. I'll be available. Any other questions or comments? Hope y'all learned something tonight. All right.
I learned something, and I thank you as always for all that you do. Praise Joshua.
You're welcome. Praise Joshua, absolutely. You're welcome. Very good. Okay. Well, if
Thank you,
nothing else, I'll let you
Carla.
guys. Oh, you're welcome. You're welcome. I look forward to talking to everybody. If you got any questions or have specific situations that you want me to kind of look over with you to see if there's anything that we need to do before the end of the year. If you have any questions directly, I have no problem. I'll meet with anybody. I'll open up my schedule more. But absolutely book your appointment as soon as possible since it's free. And I'm available. And if not, I will talk to you guys in the next couple of months during tax season. All right, y'all have a good night.
Good night.
Thank you.
Thank you.
Praise Joshua.
You're welcome. Praise God. Good night.
Good night.